This PowerPoint reviews some of the key features of accounting for private not-for-profit organizations and compares it to the accounting for similar public or government-owned organizations. Private not-for-profit organizations include voluntary health and welfare organizations, private colleges and universities, private hospitals, private museums and cultural institutions. Examples would be the American Red Cross, Stanford University, St. Francis Hospital, or the San Francisco Museum of Modern Art. The accounting standards for private not-for-profit organizations are established by FASB. Although I don't like to use the term not-for-profit organizations in conjunction with public or government-owned organizations, our textbook does use that term sometimes. But the point is, there are similar types of organizations that are public or government-owned. There are public colleges and universities, public hospitals, public museums, and cultural institutions. Examples include the University of California, San Francisco General Hospital, and the De Young Museum, which is owned by the city of San Francisco. The accounting standards for these public or government-owned not-for-profits are established by GASB. Now, there's a lot of similarity between the accounting for the two types of organizations, and actually GASB and FASB have worked hard to try to bring the standards together over the years. Both account on an accrual basis. So on the balance sheet for both a public or private not-for-profit organization, you will see non-current assets such as plant, property, and equipment. Also, you will see long-term liabilities such as long-term debt. Both of these organizations may use fund accounting internally, and very often they do, but they are required to report on a consolidated basis. So in their published financial statements, you will usually not see any funds. These organizations both prepare three basic financial statements: a balance sheet, an income statement, and a statement of cash flows, although the names of these statements may vary slightly. Although we do note that the voluntary health and welfare organizations are also required to prepare a statement of functional expense, a fourth financial statement. Both report their major operating revenues on a similar or net basis. For example, both public and private colleges and universities will report tuition revenues net of scholarships and discounts. And both public and private hospitals will report patient services revenues net of contractual adjustments with insurance providers such as private insurance companies or Medicare. Some of the differences in accounting regarding the balance sheet first. Regarding the recognition of restrictions, private not-for-profit organizations only recognize restrictions that are imposed by donors. In contrast, public not-for-profit organizations recognize restrictions imposed by donors and other outside parties, such as bondholders. So any contractual obligation created with an outside party can result in the creation of a restriction for the public organizations. Both types of organizations break down their net asset or net position on their balance sheet, but the categories used to categorize these net position and net assets are different. For the private not-for-profit organizations, net assets are broken down into permanently restricted, temporarily restricted, and unrestricted. For the public not-for-profit organizations are broken down in the same way that we saw for government-owned enterprises in the first part of the course. They're broken down, net position is broken down into net investment in capital assets, restricted non-expendable, restricted expendable, and unrestricted. There is not a one-to-one correspondence between the categorization used for the privates and the publics, so therefore it is hard to strictly compare one to the other, but there are some similarities. For example, permanently restricted net assets for the private not-for-profit organizations basically consist of endowments, and restricted non-expendable net position for the public organizations is basically endowment. Just to look at a couple quick examples, here's the balance sheet for Stanford University. And as you see in the net assets section, its net assets are broken down into unrestricted, temporarily restricted, and permanently restricted. In contrast, the balance sheet for the University of California, the public institution, its net position is broken down in the categories we just saw: investment in capital assets, net of related debt, which is the old term for net investment in capital assets. And its restricted net assets are broken down into expendable and non-expendable. And in this case, its expendable restricted net assets are further broken down into two more categories, and then we see unrestricted. If you notice that UC's balance sheet is quite long and quite complicated, it has to do with the fact that this is such a large and complicated organization. This is obviously longer than you would see for many organizations. Looking at the income statement, some of the differences. A private not-for-profit organization, its income statement has to show the change in each category of net assets. So permanently restricted, temporarily restricted, and unrestricted. In contrast, the public organization's income statement only shows the change in total net position. Because of this, on the private organization's income statement, the satisfaction of temporary restrictions, be they attributable to time, program, or plant, are shown on the income statement as net assets released from restrictions. These releases decrease temporarily restricted net assets and increase unrestricted net assets. Because the income statement for the public organization only shows the total change in net position, the satisfaction of restrictions is not shown on the income statement. To the extent there are any changes in the restricted amounts during the year, they are accounted for with a direct adjustment to the appropriate net position account. Again, you might recall from the first part of the course, we made these types of adjustments for government-owned enterprises, and we also made similar adjustments to the fund balance accounts for the governmental funds. Looking at the income statements, here's the first half or the top half of Stanford's income statement. You may have noticed in the book that many organizations present their temporarily restricted, permanently restricted, unrestricted net assets in three separate columns. Stanford uses the alternative format where it presents them one right after another. So Stanford's income statement begins with unrestricted net assets in this top half of its income statement. So you see labeled in red up there, unrestricted net assets. And within the unrestricted net assets section, we have a line for net assets released from restrictions. And in this case, net assets released increases unrestricted net assets. So we see the positive number, $108 million. Going down to the bottom half of Stanford's income statement, we see the remainder of the unrestricted net assets section. And at the bottom of that, the net change in unrestricted net assets. Following that is the temporarily restricted net assets section. At the bottom of that is the net change in temporarily restricted net assets. And finally, the permanently restricted net assets section. At the bottom of that is net change in permanently restricted net assets. So you see how the income statement shows the change in each category of net assets for Stanford. And then looking back up in the temporarily restricted net assets section, we see net assets released from restrictions. They call it net assets released to operations, but that's fine. And the same number we saw before, 108 million, which is a reduction in temporarily restricted net assets. Looking at UC's income statement, in contrast, we get down to the bottom line, and there's just a change in total net position. In this case, $1.8 billion or $1.9 billion decrease. Some remaining differences in revenues and expenses between the two types of organizations. Recognition of pledges. Remember that pledges are a promise to give in the future. Generally, private not-for-profit organizations can recognize as revenue a pledge subject to appropriate discounting for the time value of money and an adjustment for its estimate of the collectability of the pledge. Generally, these are treated as temporarily restricted as to time until the period the gift is received. In most cases, a public not-for-profit organization will not recognize a pledge until the period in which the gift is actually received. This is because the pledge is considered to have a time restriction, which is an eligibility requirement. And if you recall, for public organizations, they cannot recognize a gift or a grant until all eligibility requirements have been met. The accounting for tuition revenue is also slightly different. If tuition revenue is collected for an academic term that crosses fiscal year, there are no specific rules for the private colleges and universities. Generally, they will recognize the revenue in the period in which the majority of the instruction services are provided. So if there's a summer term that is 2/3 in the prior fiscal year and 1/3 in the following fiscal year, they'll recognize the entire revenue in the first fiscal year. The public university has to recognize the revenue in the period in which it is earned. So it has to use a matching approach. So basically, it will prorate the revenue over the 2 fiscal years. Using the following example, it recognized 2/3 of revenue in the first fiscal year and 1/3 of the revenue in the following fiscal year, matching it to the expenses related to the instruction provided. And the final difference is the treatment of bad debts. Private not-for-profit organizations follow the approach that for-profit corporations do. Bad debts are treated as an expense. Public organizations treat bad debts as a reduction in revenues. Now we'll be looking at public colleges and universities this week, and we'll be looking at public and private hospitals next week. And in both cases, we'll be contrasting the accounting between the public and the private organizations.